Madan Sabnavis, he's the chief economist at Care Ratings, joining in live on the show. Madan, thanks very much for being with us. Let's start off by addressing the Reserve Bank's move yesterday for the cut in MSF. No doubt the banks are certainly overjoyed by this move, but some would describe it as a bit hasty on account of its timing as well as on account of the fact that CPI numbers continue to remain in double digits.
No, I think when we're looking at the measures which the RBI took yesterday, I think we need to distinguish between a policy rate which is directed towards traditional growth inflation trade-off. So when you're talking of higher inflation and what should be the monetary policy measure, it's going to be basically the repo rate which we're talking of. And when you're talking of the MSF, I think the reason why it was increased in July to the level of 300 basis points higher than repo was more on account of what was happening in the forex market. Now that we have seen a great degree of stabilization in the value of the rupee, we're not quite sure whether it's going to remain at this particular level, because when we're talking of the tapering off program of the Federal Reserve, it's only been deferred for the time being, and given the fact that we have other kind of distortions in the US economy in terms of the shutdown or the threat of default by the US government. So probably the tapering program is going to get deferred. So keeping that in mind, we have seen a bit of stability in the rupee. So I'm not quite sure if this is the right time for one to actually lower the MSF rate. But another reason could also be that the RBI probably took a position that whatever measures of tightening liquidity were taken in order to control the fall of the rupee have actually served their purpose for the time being, and therefore there's reason for one to go back on the tightening measures. So I think a combination of these two factors has been what has led to the reduction in MSF. So therefore it's possibly good news for banks, but on the whole I think we need to still wait and watch and see what are the kind of global economic developments which take place and how the rupee is going to really move. Because I think in the current situation, looking at a rupee value of around 62, 63 seems to be fairly okay, given the uncertainty which is there. To a fair value based on fundamentals, I still think would stick to something like 58 to 60. But as long as we are away from that trajectory of 58 to 60 to a dollar, I think there would be certain measures which the RBI would be keeping open as far as they're concerned.
This clubbed with the previous MSF cut that was done, Madan, leads up to quite a chunky cut in the MSF rate. Do you think it will result in some funds being let out to sectors which are in bad need of cash, and could movement happen on that front?
No, actually, I have a slightly different view on it, because when we're talking of LAF, we're talking of MSF, we're actually providing liquidity. It's meant for taking care of temporary shortfalls in liquidity in the banking system. So trying to relate the release of funds that are coming on account of LAF or on account of MSF through whatever measures are being taken to saying that there are going to be more funds which are available to banking would probably not be the right way to go about it, because I think even in the past the RBI has voiced concerns that banks were borrowing in the repo market and using it for lending, which is not the right thing to do because of the ALM issues which come up. So I think the two issues should be separated. When you're talking of funds being available for lending purposes, it's got to do more with the fundamentals of your deposits and credit growth and what happens in investment, which could probably be taken care of by open market operations to a very large extent. But when we're talking of things like MSF or LAF, it's more in terms of temporary liquidity. We should not really mix up these two issues.
A simple question is, Madan, we had read a report in the Economic Times, I think a couple of weeks back, which said that even the PSU banks and the larger ones are starved for cash so much, or liquidity so much, that they are not even discounting letters of credit. It had reached such a situation. So the question really is, how does that situation improve, and what can the RBI do to improve liquidity on that front?
So on that front, I think the only way out is through open market operations, because we need to give permanent liquidity to our banking system. Because today we have a situation where your growth in credit is higher than the growth in deposits. So there's obviously a problem of liquidity which banks have. At the same time, we're seeing the government borrowing program is going as per schedule. So we're talking of growth in investments, growth in credit, juxtapose that with growth in deposits, because that's where the funds come from. And once you have a kind of a gap in liquidity, I think the only way out is for the RBI to provide permanent liquidity, which could be done through the open market operations route. Doing it through the LAF route, to my mind, is not really the prudent way out.
Madan, earlier in the day we did also chat with Dr. Montek Singh Ahluwalia, and he was fairly confident that we can maintain the current account deficit. It can even break below $70 billion. Do you concur with this kind of optimism?
No, in fact, I would tend to have a slightly different opinion because there are two issues to the current account deficit. One is the 3.7% number. I would still look at a number of between the region of 4 to 4.5% because we should just remember that when you're talking of the current account deficit ratio, it's the numerator divided by denominator. And while there could be improvements in the numerator, so when you're talking of $70 billion, our own estimate is closer towards $78 to $80 billion, definitely lower than what it was last year at $88 billion. So we're talking of the numerator reducing, but we should also remember that the denominator, on the other hand, is also going to reduce because we're talking of lower real GDP growth, we're talking of lower WPI or CPI inflation, whichever way we're looking at GDP in market terms. So I think this particular ratio is definitely going to be under pressure. So 3.7% to my mind is quite an ambitious number. It would definitely be over 4% for the year. Now, in terms of the absolute numbers, I think we still have a number of $78 to $80 billion, and while the government is confident it would be around $70 billion in case that does happen, I think it will be very good for us because we are looking at some kind of a recovery in the industrial sector during the second half of the year, which would necessitate higher non-oil imports. So even in case we're talking of constant oil prices, I think the import bill is going to start widening once the recovery takes place in the industrial space.
Just a couple of other points. Madan, a lot of people have come in and said that the government spending in the second half will be much lower than what it has been or what it will be in the first half, despite it being election year, despite the need to fund some infra projects, and maybe the government will go slow on that. Do you agree?
I think they will definitely, because I think I have a lot of faith in what the finance minister says, that the so-called red line of 4.8% is not going to be breached. But I also do believe that there are going to be major revenue shortfalls, even in case we assume that we have some kind of disinvestment which takes place, because I think that was supposed to get something like 50,000 crores. It may not be genuine disinvestment where we have these kind of IPOs coming into the market. It will be more a case of PSUs investing into one another or some such route. But there would definitely be a certain kind of revenue shortfalls because the budget was based on growth of something like 6.5%. Now when you're talking of 5% growth, it's quite obvious that your corporate tax collections and excise collections are going to come down. So there could be some kind of support provided by the depreciated rupee, which would help in increasing custom collections. But on the whole, I would expect slippage in terms of revenue collections. We're also talking of spectrum auction. I'm not quite sure if that's going to take off. And given the fact that we're going to make sure that the 4.8% number is not going to be breached, the only way out is to cut on expenditure. But there have been certain announcements made on cutting of non-development expenditure, which to my mind is more peripheral in nature. Finally, going by the track record of the government in the past, what they have done is they've really cut down on capital expenditure. And I think that's where the major concern lies, that the moment you cut back on capital expenditure, we could be starting the process of slowing down growth, because the government is one of the major initiators of infrastructure projects. So the moment the government stops spending, it's also going to affect the prospects of the private sector in industries such as cement, steel, machinery, electrical equipment, and so on. So I think that's the major fear, that not a 4.8% number, but the way in which we attain that 4.8% number.
Okay. Many thanks for getting us that update, for giving us those views as well, Madan.